All right, good evening, everybody. We're going to call this meeting to order. This is the regular meeting of the South Pasadena Finance Commission on September 23rd, 2021. It's the hybrid meeting. We're meeting both in person at the city's Emergency Operations Center and also virtually. First order of business will be to do a roll call. Vice Chair Choi.
Here.
Commissioner Finley.
Here.
Commissioner Wood.
Yeah.
And Commissioner Tao is not here yet.
Here.
Oh, you're here. Is she here?
Oh, she's here.
Okay.
Okay.
All right. Hi there. Sorry about that. And City Treasurer Pia.
Here.
All right, welcome everybody. I'd also like to acknowledge we have Interim Assistant City Manager Glenn Aguilar, Finance Manager Ellen Trin, County Manager Emily Cushion, and Lee, would you like to introduce Ken? Okay, sorry, Councilmember Liaison Donovan also.
Yes, thank you, commissioners, members of the public. I would like to take a few moments at the beginning of the meeting to formally introduce you to our new interim finance director, Ken Louie. That's K-E-N, Louie. He's a retiree, as I am, and he has agreed to come back out of retirement to help the city of South Pasadena. As you're probably aware, my last day is next Thursday. September 30th is my last day. Believe it or not, I've been here a year. September to September, it's been a year, a very fast year. So we are fortunate that Mr. Louis has come out of retirement. He has been here since September 1st. So we've had a full month of overlap between Ken and myself so that he can get up to speed and just hit the road running and continue all of the progress that we've made over the past year. He has more than 33 years of municipal finance experience, having previously served in the cities of Los Angeles, Montebello, Southgate, Lawndale, and most recently was the interim finance director for the city of San Gabriel for a full year while they were recruiting for a finance director. He has, as you can imagine, countless years of experience completing city audits that have always been given the highest audit opinion. He has written policies on internal control, general accounting policy. His degree, he has a business administration degree with an emphasis in accounting from Cal State LA. So I'd like you to just join me in welcoming Ken. As I mentioned, he's hitting the road running and he actually has your first item on your agenda this evening. That's his item. So needless to say, we're very pleased he was available to help us.
It's great. Welcome, Ken. And great to have you here with us. So yeah, with that, let's move on to the first item of the agenda, which is pension and OPEB liability alternatives.
Mr. Chairman, honorable members of the commission, as you're aware, most California cities are facing unfunded liabilities with regard to their pension plans, as well as their OPEB, which are their other post-employment benefits. The city of South Pasadena is no different, and the city council has requested that the Finance Commission evaluate funding alternatives and come back with a recommendation as to how to pay down this liability. Last year, the city council approved a new cell tower lease that will result in the city receiving a one-time $4.3 million revenue payment. Subsequent to that, the Finance Commission had concurred that using these funds to pay down the liability was the most prudent action going forward. At this time, those funds have been placed in a designated reserve awaiting final city council determination. The final decision, however, will be part of a strategic planning process, as well as making other major decisions with regard to the use of the $6 million in COVID relief monies, also known as ARPA monies. Tonight, per the city manager direction, staff has secured the services of Bartel and Associates to perform a thorough analysis of both our pension obligations as well as our OPEB obligations and state clear and recommended options going forward. Tonight, we seek to get a firm recommendation from the commission as to which option they are advocating going forward. With us tonight, it's a pleasure to have Mary Beth Redding, who's the Vice President at Bartel and Associates. She'll do the presentation.
Thank you very much.
So I think you all received by email the study we did. It's voluminous. We're not going to do every single page in detail, but yes.
Did you want to start sharing the screen?
Sure.
We can just check commissioners by Zoom. Can you see that screen?
Yes.
Yeah, the first half of the page. Yep.
Yes.
Yeah. I'm
Okay.
gonna- Hopefully I can drive and talk at the same time. And also, it's so nice to be in person and I can see your faces, only the people who are here live. So everyone else, if you have questions, please jump in and ask them. I'm not going to be able to see you necessarily, so be loud. But it's a long presentation. I'm going to try to spend a fair amount of time on the background because I think it's really important to understand. Then look at where particularly your pension rates are going and what you can do about them, and then talk about OPEB. But we're going to skip a lot of stuff in the middle because otherwise we'll be here at least all night. Okay.
Before you get started, we are in the Emergency Operations Center in the fire department. The only interruption to the meeting might be if they get a call, you actually can hear throughout the whole building, the call. So should that happen, we'll just pause and resume as soon as the call's finished, because you won't hear us over the intercom of the building, sending our public safety professionals out into the field. Okay.
Okay.
I didn't want you to get started.
What I'm showing on the screen is the presentation. I think everyone was emailed. I'm going to skip a lot of pages, but as I said, I'm going to start with background and talk a little bit about CalPERS. Your pension liability, the bigger amount of the unfunded is with CalPERS. And because of that, the city has a lot fewer options about what to do. OPEB in a lot of ways is easy because you have so much more control. So in CalPERS, you're a member of the CalPERS system. CalPERS is an old system. It's been around since 1932. It lives in the California government code. So all the rules about what it can and can't do are in the government code. Just in terms of size, they have 2.1 million members, meaning employees and retirees who participate. There's 1,500 public agencies like the city who participate. And as of about a week ago, they've got $485 billion of assets to invest. It's the largest US. So CalPERS has in the state, in the government code, certain benefits it's allowed to offer. The CalPERS organization administers those benefits in accordance with the code. So they can only do what's in the code. So they offer the benefits that are required to be offered. They administer them. They do the calculations when people leave. They track all the data. They collect the contributions that are required from cities and from employees. And they invest the assets. So there's a whole bunch of people in a big old building up in Sacramento that are CalPERS that run your plan. The actuaries at CalPERS determine what the contributions are and how much each city has to pay. And they do that in accordance with policies that CalPERS board sets. So I'm glad we had this introduction because a lot of times I forget to say, I don't work for CalPERS and all this bad stuff I'm telling you about, I'm not the one who did those calculations. CalPERS does. Okay. The board sets certain policies about like what the discount rate is going to be and also about how they're investing the assets. That's all done by the board. The board has 13 members. They meet every month. I like this slide because it's really interesting who the members are. 13 of the board members are elected by the plan participants, the employees and the retirees. 4 of them are appointed by state government. 3 others are appointed by the governor. And you'll notice this first one, elected official of a local government, is really the only representation that local government has on the CalPERS board. So cities don't get together and vote on a representative, only employees vote on a representative. So it's not a very necessarily city-friendly organization. The board does say they love hearing from people. They would love everyone to come to their meetings and tell them what you think. CalPERS pension plan is a defined benefit plan. That means that when people retire, they get a monthly annuity that's paid every month for their lifetime. And if they so elect to their spouse or beneficiary, that is calculated according to a formula that's based on kind of their final pay times their number of years of service times some factor. You do that formula, that's the pension people get. So it has nothing to do with account balances or the stock market. City of Pasadena employees, I believe I'm correct, are not in Social Security at all. Okay. So this is their only source of retirement income.
And some, you're right, some part-time.
Part-time, over 1,000 hours. The employees help pay for the cost of the benefits. So we have these sort of big split in California of public employees hired before and after 2013. So first hired to government service. We decided it was bad to call them old. The classic people, the pre-13 hires, have a fixed employee contribution, and for South Pasadena, that's either 7 or 9% of pay. They pay that all the time. The city pays everything else required to fund the plan. The PEPRA employees who came in under this PEPRA law, first hired in 2013 or later, are required to pay half of the current cost to fund their benefits. So their contributions will move up and down. The classic employees always have a fixed contribution, and the city is picking up everything else, and the everything else has gotten to be quite a big piece. Some definitions that I'm probably going to say a lot. Normal cost is a word that means the cost of the benefits people are earning each year. The actuarial liability you can think of as an accumulation of all the normal costs that were paid in the past. So it's the value of all the benefits earned for past service. It would be great if we had enough money set aside that equaled the actuarial accrued liability. Typically, most people don't at this point. Every year, the CalPERS actuaries will kind of measure, do we have enough money or not? They will identify all the new pieces of shortfall or overage, and each one of those pieces becomes like a layer on a cake, and it's paid off separately. Or it's like having, I don't know, a stack of 30 mortgages on your house. Each one has a different term and a little different payment pattern. All of those, the payments due on all of those pieces are added together to your normal cost payment, and that's what the city is required to pay each year. It's a really basic pension rule. This is so obvious. You're going to say, why did I write this down? But things have to balance in pensions. CalPERS needs to pay the benefits they're required to pay, and they have to pay the expenses of running the plan. The only way they can get money is by contributions that are paid by either the city or the employees, plus the investment earnings. There's nothing else. There's no other magic source of funds. So if people start living longer, it means they have to pay more benefits. That means more money has to come from either employees, employers, or they have to somehow generate more investment earnings. If investment earnings are falling short, they can't reduce the benefits. It means contributions have to go up. So it's a really closed system. It has to balance. Okay. Talk about history, kind of again, as quickly as I can. This is a chart that charts CalPERS investment return back to 1996. So all of the points on the green lines are what CalPERS investment return was for each year. The blue line is what the actuaries' assumptions were for the year. So the actuaries will make an assumption that the fund will earn a certain percent every year in the future, and they need that money to pay the future benefits. If the fund doesn't earn that much money, it's a bad year, it's a loss, even though you have years where maybe the fund earned 4%, okay, more than zero, that was not a good year because the actuaries were assuming 7. See lots of ups and downs. We have the 2002 dot-com bubble. We have the 2008-9 crash, a lot of ups and downs. And then we get to 2021, which was a really good year. CalPERS earned 21%. The average, the brown line is the rolling 20.
Yeah.
My slides.
20 and 30.
I think it's a 10-year average. We don't have the.
It says 10 year.
It's a
10-year
It's a
average.
10-year
10-year.
average. Which very nicely in the past couple of years has finally come up above the assumed rate. Until then, it was always below the assumed rate, which is a little bit distressing.
Is that cumulative?
That's over the 10 years,
Okay.
the previous 10 years. So it's a
All
rolling
right, so it's
10-year.
cumulative.
Yeah, and part of the reason it popped up was because 2008 and 9 finally dropped out of the 10-year period. Okay, so there is sort of this myth you'll hear that CalPERS has never made their assumed rate. Well, that's wrong. You know, many years it was good, and even when you look at the very long-term averages now, they're over the assumed rate, although not by a lot. And it certainly doesn't happen every year. So the question is, if CalPERS has been doing pretty well, why are the plans in such a poor funded condition? What happens is, if you think about 2008 and 9, they had very big asset losses. The CalPERS was asked at the time to do a lot of smoothing. They were told cities can't afford for the contributions to go up to make up all these millions of dollars that we've lost. So they did this thing called asset smoothing, where they averaged the losses, or if you think about it, maybe unkindly, you might say they pretended they had more money than they did when calculating the contributions cities would pay. So not enough money was really going back into the fund to make up the losses. And when they did have the good years, there wasn't really the funding there to take advantage of that. Their methodology did a great job at keeping contributions really smooth. It did a really poor job at getting the plan funded. We'll see funding statuses later. They've been very, very flat for probably the past 8 years or so. It's not improving. The other thing that's going on, and I have to pause here and really commend the city of South Pasadena for your foresight. In the early 2000s, there was sort of a wave across the state of California. CalPERS was very well funded. Many of the plans were close to 150% funded. I think you guys were probably about 140%. What are we going to do with all this money? We don't need it. I know, let's increase benefits. And there was a wave of benefit increases, particularly in public safety, to the point where if you talk to people who were there then, they said we had to increase benefits because otherwise we couldn't hire anybody. South Pasadena did not do that. What happened was these benefits increased, sometimes 50% of the pension, sort of overnight for all existing people, and employees were not asked to contribute towards those higher benefits. So that happened. It increased liabilities. Again, South Pasadena didn't. And right after that, we had the dot-com bubble, and funded statuses have just never come back. It was very costly. And when you look at the most poorly funded plans, almost all of them did these enhanced benefits. Little bit here on the bottom about the PEPR tier, just to kind of keep in mind, because these people are becoming much more significant. These are the post-2013 hires. Employees are paying half of the normal cost of their benefits. They also have a limited pay. So if the employees are not in Social Security, no more than $153,000 of compensation can count. Right now, that kind of hits, you know, maybe an executive you're trying to hire in. But for public safety, it won't be, we think, very long before sort of run-of-the-mill employees are running into that gap, and that could be problematic. But it's nothing this group can address.
When you say problem.
What happens if your run-of-the-mill firefighter who's been around 10 years is making $180,000, but his pension's only based on 150? Yeah. You know, and there's a point where, you know, if it's an executive type person, you can do something for them, but when it's all of your public safety people, it's really hard. I'm going to skip those charts. Talk about one thing really briefly, which is demographics. If we look across the whole state, and Pasadena is really not any different, and actually the country is not any different. We see that every year we have more and more retirees compared to actives. The retiree population is growing. The actuaries call this not being a mature group. Hard to say diplomatically. It means more people are retiring than are dying. Okay, we're not yet to that steady state. Okay. Why is that a bad thing? It causes volatility. The more retirees you have and the more assets assigned to those retirees, that gets to be a big pool of assets. Every time there's an asset loss, it means there's more money to be repaid. Those retirees are not in your city budget. You're not paying them payroll. So there's like this big outside pool of money that's having ups and downs. When it does, it affects your payroll, and it just magnifies it the more retirees you have. Having retirees is good. That's why we have a pension plan, and we like them being funded, but it does cause more volatility. That means your costs will go up and down more than you expect going forward. CalPERS has been making lots of changes in the past many years. They've realized that smoothing didn't work very well. They've gotten rid of a lot of their smoothing. They've changed the way they amortize things to make it a flat payment. The system they were using before started your payments, like your mortgage payments, really low, and it meant that the outstanding balance actually grew for like 17 years out of the 30 before it grew and then came down. 17 years out, you've been paying and you were back to where you started. So it wasn't a good system. It wasn't working well. They fixed that. They just finished dropping the discount rate. They expected future earnings down to 7. All of these things are getting the plan into a much better condition. We hope a better estimate of what the true costs are, but they all cost a lot of money. And a lot of those changes were phased in, meaning that your rates are scheduled to go up as they're being phased in. 2 current things. Risk mitigation strategy was adopted in 2015. What it said is, we know that the fund is volatile. We wish it wasn't. We wish that the earnings were more stable, but we know if we take our whole fund and put it in like bonds, or even worse, cash in the mattress, it's going to be really stable, but the rate of return will go down. So we can't do that all at once. How about if we wait until there's a really good year, and then when there's a really good year, we'll sort of take some of our stocks and move it to bonds. That'll drop the discount rate just a little bit, but you'll be so happy about the good earnings, you won't really care. The first time that got triggered was this year. And so CalPERS has announced the discount rate is going to go from 7% to 6.8%. But these are 2 things that just happen to be happening at the same time. If you ask investment advisors right now what they think about future earnings, they all say, we don't think earnings in the future are going to be anywhere near what they have been in the past. They told CalPERS this summer that if you take the very same portfolio that had a long run expectation of 7% 4 years ago, right now they think the long run expectation is 6.2. How can you have a discount rate of 6.8 if you expect 6.2? So the board is struggling with a lot of things. They'll make a decision in November. They're struggling with, should we leverage the portfolio? Should we borrow and use that to jack up our earnings to keep them at 6.8? Should we put more private equity in it? Or should we all just kind of suck it up and pay a lot higher contributions? We don't know what they're going to do. They'll do that in November. So the rest of our report is based on everything as it is right at this moment. That's best we can do. Okay, so I should pause for questions. That was the end of the history. Okay. I'm going to talk about the miscellaneous plan for miscellaneous employees, and then separately for safety. I'm going to do them kind of quickly, and safety is a lot of repeated miscellaneous, so we'll go really fast through that. We have this really pretty chart, except we don't know what happened in the middle here. We don't have those valuation reports, but it's just tracking head counts for your miscellaneous employees, where the blue is the number of retirees and the red are the active employees. And you can see in the past 10 years, since 2011, we really have actually reduced head counts of active employees at the city. I don't know if that's maybe not necessarily the best thing, but certainly increases in retirees. The city's unfunded liability right now for miscellaneous is about $16 million. Here's the green bar is the assets. The colored bar is the liabilities, the value benefits that's owed in the future. And I like dividing it up into colors. The dark blue is how much we owe for retirees. And it's always nice when assets cover, we have at least enough assets to pay off the retirees. Even though you would never give it out that way, it's just sort of comforting. The light blue is people who used to work here but don't anymore and are not yet retired, who have a benefit. And then the purple on the top is how much is owed for active employees. It's about $16 million. We have a chart of what the funded status for the miscellaneous plan is. You guys don't have the dots because I just totally made those up, so I didn't want to give them to you. It was close to 140% way back in the year 2000. What we know most plans did was that funded status tended to drop till about 2002. It recovered, and then whammo, it hit 2008. It recovered a little bit, but it's been really steady since then. You know, that's really the problem that CalPERS is trying to address. You know, we had all these years and we could not improve the funded status. Again, we're missing reports in the middle. This is a different look at the funded status, where the green is the assets. So they fell, they grew, they fell, and the assets have actually been growing in total dollars since 2011. The problem is the liabilities have been growing very steadily also. One of the issues with pensions is if the assets grow at 7% and the liabilities grow at 7%, they're never going to catch up. They're just going to stay on these two really nice parallel lines. How do we get the assets to catch up? We have to put a lot more money into the fund. Or we have to earn 15% year in and year out, which is not going to happen. So these are just sort of, you know, history pictures. There's another picture, again, you're missing the middle, that tracks the normal cost, which has been sort of flat, and the unfunded liability going up. Most of the contribution increases the city has been facing have had to do with unfunded liability, particularly the asset losses. Let's skip, and go on to projections. Here's what you probably were more interested in knowing is, where are we going from here? Where are the city's costs going? I want to talk a little bit about what goes into the projections before we do the numbers.
Firehouse response.
Good evening, this is a 1900-hour test of the ITI alerting system for Diego Clear.
Okay. These projections have everything we know in.
For Duke LA County Battalion 3 en route.
I'll let you know when the light goes out.
Battalion 3.
LA County Engine 1 en route.
As soon as I say something, I know that. Okay, so we have put in the 2021 returns into our projections. We've built into these expected investment returns. So we don't just say, oh, CalPERS says this fund will earn 7% every year, we'll make it earn 7%. We do what's called stochastic modeling, where we have 1,000 random trials of what the investment earnings might be. And it's not a random trial, it's sort of weighted towards what you would expect given the asset mix impact. So it's most likely to come up 7%. It's a little more like, less likely to come up 6% or 8%. Pretty unlikely to come up, 15% or 1%, but it will occasionally. So you get an idea of how likely things are. So we're doing projections, and we're going to show you how likely the contribution rates are to be at certain places. We've also taken into account the risk mitigation policy that's going to lower the discount rate. We've taken into account that long-term returns should be better than short-term returns. And we've taken into account that current classic employees are retiring and being replaced by PEPR employees who have achievement benefits. All that said, let's look at the first 10-year projection first. These are all expressed as contribution rates, which is sort of part way how CalPERS still bills you. It's the dollar amount of payment divided by payroll. So right now for this year, for miscellaneous, between all the different little risk pool plans, you're paying just under 27% of pay to CalPERS. That's the employer piece only. Every dollar the city pays in payroll, 25 cents goes to CalPERS. We think, and this is a really kind of funny shaped line, but most likely that'll go up next year. It'll drift downwards for a few years as we phase in the really good 2021 returns. And then it'll start drifting back up again as a lot of the other things that were scheduled to phase in come in. So the green line is sort of our 50th percentile, the most likely place the contributions are going to be every year. They're never going to follow the green line. They're going to go wandering up and down, but hopefully they'll stay near it. The little numbers on top and the bottom are the 25th and 75th percentile returns. So not particularly unlikely. Half of the time, in fact, so in half of all of our trials, if I go 10 years out, the contribution rate is somewhere between 11% of pay and 39% of pay. A quarter of the time, it's more than 39% of pay. A quarter of the time, it's less than 11%, although it's sort of a floor, it can't get that much less, it'll kind of bunch up. So there's quite a bit of variability given the way CalPERS is structured. It's very hard to predict, but this is our best guess for where things are going. If I go out 30 years, the graph gets smushed. The first 10 years of the graph are what we saw before, but it's just smushed, so it looks steeper. It's really not any steeper. So you can see the rates drop a little bit, they come up a little bit, and then after about 11 years or so, they really start dropping. And that's when the old unfunded liability is scheduled to be paid off. And then when you come down to the early 2040s, the line sort of flattens out, and at that point, we're just paying normal costs. Most of the time, the unfunded liability is. How did we get there? The city paid a lot of money between now and then to make that unfunded liability go away. And it's certainly not, you see all these little numbers up here, it's not at all, would not be unexpected if the rates were still fairly high that far up, but most likely they'll be down. I think I want to skip these for time. Really quick run through safety. Safety is much smaller. We have 53 safety employees. These are sworn safety officers. They have $30 million of unfunded liability. Everything is always in pensions. Everything is always worse for safety. Safety members have more generous pension formulas, so they're getting a bigger pension benefit. They tend to retire earlier than miscellaneous employees, which means they're collecting their pension for a longer time. It also means you have less time to save up the money to pay for their pension. And they end up, for at least, particularly for the non-disabled safety people, they live just as long as miscellaneous people. So they're collecting their pension for very long. So it means that their pensions are more expensive, and anything bad that happens to a miscellaneous plan happens the worst to a safety plan. They have $30 million in unfunded liability. Skip all these because they're pretty much the same. Your contribution right now, if I'm reading it right, is 61% of that. Meaning for every dollar of payroll to a safety member, 61 cents is going to CalPERS. That's again going to drop really slowly over the next few years due to the great asset return last year, and then increase and kind of stay about where it come back to about 61%. It gets a little bit higher, and then sort of the same thing drops down until about the 2040s where it levels out.
Is there a state average for the contribution percentage for safety?
60 may be close to average. We don't have any numbers released statewide for this. It's not going to make you feel better, but I've definitely seen 80s. I've seen projected close to 100%. Yeah. You guys don't have the enhanced formulas. It's really helping. You'll come to a chart that turns it from percent of pay into dollars. The dollars inflate because payroll's inflating. So right now, this current year, we would project that you're going to pay $4.8 million to CalPERS. That's a regular contribution. We're not talking about the extra $4 million. And that by 2032, 33, that's going to be more like $7.5 million. So you're looking at a very big increase going forward. Most of it's coming from paying off the unfunded liability. The benefits people are earning are lower and stable. Take a minute and talk about leaving CalPERS just to make sure that it's kind of a ground rule. We can't do it. Okay. So CalPERS says part of the deal with CalPERS and in the state law is that if you join CalPERS, you're in. And you're agreeing that you're not in just for the current people, you're in for all your future hires. You can't say, I'm going to freeze my benefits and put everyone in a 401k plan. That's terminating. And you also can't say, I'm going to put my new hires in a 401k plan. That's terminating. If you want to terminate your CalPERS contract, what CalPERS says is, okay, we've agreed to pay pension benefits for these people. We need enough money to do that. We're going to invest really conservatively because we're never going to have an opportunity to go back to you and ask for more money. We need to get enough that we're sure. And so they ask for a lot of money. How much they ask for? Right now, the total unfunded liability from the city's benefits is $45.7 million. They would ask, depending on rates, for you to pay somewhere between $167 and $255 million. Okay, you're laughing. That's why we're not leaving CalPERS. We're not talking about it. If you had that much money, this whole meeting would not be necessary. And you're not even done because sort of on the state law, you're probably required to pay future, you're going to have to put in a replacement pension system. So that wouldn't even be done. This is why people don't leave CalPERS. We have some stuff on cost sharing. I think I'm going to skip and get to talk about what can we do to pay off the CalPERS unfunded liability, or $47.5 million. Those liabilities are growing right now at 7% a year. So to the extent you can pay them sooner, you can save 7% a year. Right? So that would be a great reason to pay them off sooner. All the options for mitigating your future contribution levels have something to do with paying more money and paying it sooner. So there's a lot of discussion about sources of funds. You might have city funds, as we do. Borrowing is popular. POBs, pension obligation bonds, are very popular right now. And some people bargain with employees to have their employees pay a bigger share of the total. It's really hard to get $47 million from your employees. I mean, we're at the point where they can help, but the numbers we're looking at are just too big. So assuming we have money, and we know we have money, I want to spend more time talking about what should we do with it. Skip POVs. So there's really two categories of what you can do. Wait, there's 64. The two categories are give the money to CalPERS or set up a thing called a supplemental trust or a Section 115 trust. If you give the money to CalPERS, we, Bartel Associates, think that probably that's going to have the best return in the very long run. The reason we think that is because CalPERS is a big organization. They have a lot of people who know a lot about investments. Even if we don't necessarily agree with what they're doing, they are taking a lot of risk, but we think in the long run that should pay off. The other thing is that they're a public agency and they're not making a profit. Most of the other alternative sources of funding, like a supplemental trust, most are run by private companies. There is some profit coming out, so they are going to have higher expenses, and nothing else that should give them a little bit lower return, again, in the very long run. If you give money to CalPERS, it's locked in. You're going to make a deal with them when you send them the money, and you're never going to be able to change that deal. So you can't, if you give them extra money and then something terrible happens next year and you can't pay the regular bill, you're not able to say to CalPERS, but look, we just sent you all this money last year. They will say, too bad. Where's this year's payment? The other thing that's a big twist, I haven't talked about this facet of the PEPRA law yet. What PEPRA says is no more contribution holidays. Even if your plan is fully funded, you must keep paying the normal costs. So you can get yourself in a situation, I worry about some of the people issuing pension obligation bonds. They've funded their obligation 100%, then CalPERS went and earned 20%. Now they're way overfunded, but they still need to make those normal cost payments. So it's just sort of a wrinkle that comes into this cost. Okay, there's two ways you can go with CalPERS. One is called a fresh start. Think of this as refinancing your mortgage. I told you he had a lot of layers of unfunded liability. CalPERS will smush them all together, and maybe you were paying on average over 20 years, you can pay it on average over 15 years. So it'll be a shorter payment period. That means you're going to pay less interest. Unlike refinancing your mortgage, you don't get a lower interest rate, same interest rate, but you still save money because you're paying faster. The problem is when you're paying faster, in the short run, the payments have to go up. If you do a fresh start deal with CalPERS and then something bad happens, you can't revert to the deal you had before. You're stuck with a higher payment. So nobody, almost nobody likes this and has signed up for it. A lot of people had said, we would like to make payments as if we did a fresh start. And you can do that. They call it a soft fresh start, but it's actually very difficult administratively. And I'll talk on the next slide about why that is.
Good question.
Yes.
The interest, what is that calculated based on?
7% of the outstanding balances. So the lower your balance, less interest. So the other way to pay CalPERS is generally called, they call it now additional discretionary payment, or ADP. This means you gave them some extra money. Here's the problem with it. You have $4 million. You go and give CalPERS $4 million. They say, great. They say, okay, well, city, we will recalculate your contribution that you owe us next year. You were going to pay us $1 million a year, but now you only have to pay us $900,000 next year, and every year after that. And so you don't really, you're sort of spending that money to reduce your future contributions. You're not actually paying off the unfunded liability any faster. You're still saving money and you're saving interest. It's still a good deal, but it's maybe not the deal you wanted. You wanted just the unfunded to go down and to make the same payments. CalPERS can't calculate what the payments They can't bill you for the payments that you would have paid if you hadn't sent them the extra money, which is what's hard about the Fresh Start thing. So I give CalPERS extra money. I call up Mary Beth. I say, Mary Beth, calculate for me what I would have paid if you did, if I didn't have this extra money, I do that calculation, you pay extra. Next year, you want to do the same thing, except now we have 2 years of extra payments. And pretty soon you're having to go to council every year probably and saying, CalPERS is billing us 600,000, but we want to pay $1 million. And it gets very difficult to keep, both in the calculation and sort of politically keep paying more than your bill, paying more every year. But if we ignore that for the moment, CalPERS will give you options for how you want to apply any extra payments. You can sort of have the money applied over a longer period of time or a shorter period of time. They'll do either way. And as I said, the last bullet was what I was trying to explain is if you can keep paying on the current payment schedule, that will really save you far and away the most money, but it's very hard. Okay, let's talk about the supplemental trust. This is a separate legal trust. It's qualified under IRS section 115. It holds, the money it holds can only be used for pensions. It can be paid directly to CalPERS or it can reimburse the city for a payment you just made to CalPERS. Cannot be used for anything else. The good thing about these trusts is they're not city funds, so they're not subject to the restrictions that the city has about what it can invest in. It can invest, whoever's running the trust is a fiduciary. They have fiduciary responsibilities. They can't go crazy, but they can invest in anything they think is fiduciarily responsible, like stocks and bonds. So that should get a much better return in the long run than just keeping money in the city. Question?
Well, no, I'm listening to you. And I'm thinking back what you said in the beginning is that we have an opportunity of saving our city about 7%. Like it is. And coming back to that number and coming back to what you just said now, in terms of going into a supplemental trust, it's a trust. Before it was very difficult to send this way.
Would be difficult to beat 7. Some people, some people think of these as sort of, almost short-term savings accounts, budget stabilization funds, and they say, well, if I beat like 2%, what am I getting on city money? If I beat on 2%, I'm ahead. A little bit depends on how you look at it. The assets in a supplemental trust don't count for accounting purposes. The GASB thinks that cities have a little too much discretion about them. That's not the way they wrote the answer to their question, but I think that's what they were getting. Because this, you've got a lot of choice about that money, but it is a city asset. So it would appear, you would write a nice little note that says, dear pension note readers, make sure you look over here and see all this money we have set aside in the restricted fund for assets that we can't add into. It's a restricted fund for pensions that we can't add into these numbers. There's a lot of these trusts. They're fairly new. They mostly started since 2015. There are now, there's 3 providers. All the first 3 are private companies, ours, PFM and Keenan, that have big trusts that you would invest in a piece of it. And then CalPERS has just opened their own fairly conservative Section 115 trust. Why would you do this? I told you that if you give money to CalPERS, it's very locked in what you're going to do with it. If you put money in the trust, it's totally up to you. You decide when you're going to put money, or if you're going to put money in the trust, and you decide when you're going to take it out, or if you're going to take it out. Totally up to you. So it has a lot of flexibility. People who do these usually are doing one of 2 things. Either they're building up money to use to kind of stabilize their budget from fluctuations in costs, or else they're just trying to accumulate a lot of money. When they get a lot, they're going to turn it over to CalPERS and say, now we're full. So the choices question.
So we put it in the supplemental trust, pension trust, and it becomes part of our balance sheet.
Yes.
So we still have that.
You-
And that was good in terms of the balance sheet for the city.
Right.
So we have to put it- That's the plus side.
You have the money, but you can't
You can't use it.
only spend it on. But if you owe CalPERS $1 million this year, you can pay that $1 million out of the trust instead of the budget.
Well, the other way to look at it, I think, is that if you put it in a pension trust, you look at the liability to CalPERS, and you got history, you net the two out.
Yeah.
Book wash, you reduce your liability.
Yes, in real life you
Accounting
do.
wise,
In
yes.
real life you do.
Right.
You're not allowed to show it.
I understand that, but that's, what looks at that, your net liability would be reduced by.
Right. Exactly.
Okay, right.
So I'm always asked, what should we do? Should we put our money in a supplemental trust or should we give it to CalPERS? So here's my side by side. Supplemental trust is flexible, CalPERS is locked in. Probably though, CalPERS will have better returns in the very long run. CalPERS, you don't get a choice of investments. If they want to be highly risky, you're stuck with their highly risky fund. If it's your supplemental trust, you can choose how much risk you want. You know, do you want a really conservative fund that's going to beat city money, but not by a lot, or do you want to take a little more risk? Supplemental trust, as we said, doesn't count for gas accounting. It's much more visible. This is actually, I think, a big differentiator for people. You'll get a statement, you'll know how much money is in that trust, and you'll be able to say to your taxpayers, here's what we did with that money. See, you know, it's turned into 6 million or 8 million or whatever. If you give it to CalPERS, we can track it for you. It's a lot of work, and it's, you know, there's a lot of feeling of it just went down the rabbit hole. You know, it's hard to tell. You know, we gave CalPERS $4 million and they had a minus 10% year, and where is it? So the decision is usually made, probably most often, about flexibility. Can you afford to give this extra money to CalPERS and just have them have it, or do you need to keep it where you can use it to help out your budget if you really need to? Usually the biggest driver, a lot of the drivers are, other drivers are, I don't trust CalPERS, I don't want to give them more money than I have to. Or, gee, I don't want it to be my responsibility to pick where the money's going, let's give it to CalPERS. It's not very often driven by the numbers. Usually it's a very subjective decision, but most often around how flexible are you about needing this money. You have a lot of numbers first. I've told you you could save money. What we did for the modeling was to take $4 million and we split it up sort of according to unfunded liabilities. So we said, let's give the miscellaneous plan 1.2 million. Let's give the safety plan 2.2 million, and we'll give OPEB $600,000. Let's look at the middle one, because this is the one that is the most common, applied to long basis. So if you gave the miscellaneous plan $1.2 million, you would save on top of that $1.2 million in terms of the amount of savings every single year, you would save 1.4 million. The present value of the savings about 600,000. I take the present value of 3%. Doing that for safety, 2.2 million, you would save about $2.6 million in cash over 30 years, and the present value would be about $1 million. So the savings we're talking about are really big. You're saving 7% interest on that money. If you could keep paying the contributions you would have if you didn't give that extra money to CalPERS, really hard to do, the savings would be so much more, okay? The 1.2 million would save you close to $3 million with the present value 1.1. And the 2.2 would save you almost 5 million. And the reason is because with the middle option, the normal options, you're kind of spending that money every year as you go along. And so it's just not giving you as much bang for the buck. But it's certainly the very easy option, and there still are a lot of savings there.
if I could, the do not let payments reduce, just to make sure I understand. You're sending all the money to CalPERS. And let's say whatever the numbers were, 4 million we paid this year, we would pay whatever 4 million again next year as an example.
You would pay,
And not a reduced amount because,
yeah, let me go to this chart.
is this where you're saying the example you gave where our bill from CalPERS will be smaller, but we're gonna actually pay more?
Right, so this green line is our old projection we had of what the contribution was gonna be. It doesn't show up that well on the screen.
Okay,
If you want to do that, do not let the payment reduce. It'll be this blue line. So you send them extra money the first year, and then every year after that, you'll pay
Okay.
exactly what you would have paid. Until you get down here where guess what, you're done. If you do the one I said you're most likely to do, the long basis, you would actually be on this dotted line. So CalPERS would bill you a little bit less than the green line, and you'd be paying a little bit less every year, and finally it would kind of run out.
okay,
We're talking out about 15 years now.
Yeah.
okay.
One of the things I like about this chart is that even though $4 million seems like a lot of money, it's really hard to see the difference in those lines.
Sure.
It's making a difference in your contribution. It's saving a lot of money, but relative to the whole numbers, it's sadly small.
So I have a question.
Yes.
So, going back to that table with the three scenarios. So, the second number in each section, you did a present value using a discount rate of 3%.
Yes.
And it looks like in none of those scenarios, we make our money back.
Yes,
The present value is always less than the amount that we put in. Is that correct?
that's the savings on top of the money you put in.
Oh, so the net savings on top of that. Okay.
Top of that.
Okay.
Yeah, no, you're right. Otherwise, it would be a bad deal.
Yeah. That's fine. Okay.
We're looking at 10%, 7 plus 3, right?
7
Yes.
plus 3 is 10, yeah.
Yeah,
Pretty good.
but it's not a one-year savings.
No, I
It's a
understand.
30-year savings.
Yeah, as your graph showed. But it's never something to keep in mind.
Yeah, I mean, it's still, it's,
In terms of return.
Yeah, and kind of to put that in perspective, if we were just to hold on to the money right now, we're getting less than 1% in life.
Yeah.
yeah,
So by sending the money to current CalPERS, hypothetically, we're getting 7%. So we're getting locked on 7%.
Yeah.
Versus holding on to the money, we get less than 1%.
And it's guaranteed for 15 years. That's
It's got to be.
how many times that double? And that's very impressive. Yeah.
so I need to tell you that it's not guaranteed return, right?
Yeah.
Yep.
CalPERS could lose it. And because you gave them an extra $4 million when they have a bad year next year and have minus 20% return, they have a more loss than they would have otherwise because they started with more money. And so it's more money that you have to move up. But it's certainly over 30 years, the chances of them outperforming life is really, really high.
But as you showed in the earlier slide, every 10, if we were to grade CalPERS on every 10 years, they kind of passed every 10 years, so to speak.
Yeah. Yeah. And again, I just have to keep saying not guaranteed.
Yep.
Not guaranteed.
Yeah, I have another question. You mentioned earlier that, whenever we have a big year like we just did with the fiscal year ending in June, the benefit of those big years get amortized over a number of years going forward.
Yes.
Is there any game we can play where we try to time extra contributions to get the benefit of big years or otherwise? Like if we put in money right now, do we get any of the benefit from that 21% return?
No, it's too late.
Yeah. Okay.
Sorry.
Yeah.
But it would be nice if you could do it retroactively. But
No, I mean, it's purely an accounting issue, but I was just curious if there's there's a way to kind of take advantage of whatever formulas that they're using.
So what they do let you do is if you had given them money anytime during the 21 fiscal year, there's too many 21s, during the 2021 fiscal year, in which they earned 21%.
Uh-huh.
If you had given them money on January 1st, you would get half of 21% on your money, or 21% times the amount of time it was there. You gave it to them. April 1st, you would get a quarter at 21%. So they don't actually track, which particular days the market went up and down.
Oh, interesting. So they'll average it out over the whole year.
Right. So
Okay.
there might be something to be gained if you knew the first half of the year was awesome. You could put your money in, but you're still gambling that it's not going to go the other way.
Okay. No, so there is a benefit because, if you drop in the money on Jan 1, you've already locked in half of your return by just looking at, just looking up the chart.
Yeah, but it could it could all go away in the
Right, but that's only half. You're only exposed half.
Right. Okay. But other than that, you can't do it.
Okay.
When you do reduce your expense, as you said.
Right.
It's a big number.
It's a big number.
Yeah.
Okay, so let me show you the savings if you put it in a 115 trust. And what we did here is because it's all up to you, I can't really calculate what the savings are. So we did one scenario, and it'll be easier to see in the pictures where we calculated a savings and a present value, and these are lower. And I'll show you why. And I'm going to go all the way down to the 115 trust. Skip all these that show a lot of lines together. This is 79. So this is how we think about a 115 trust that's used for budget stabilization. The green line on miscellaneous is the same curve we saw before, right, of contributions. And we said, let's say the city puts this $1.2 million in a trust. And let's say that money just sits here while the rates are going down. But once the rates are going up, the city decides that they want the rate they pay CalPERS to be 25%. So any year when the CalPERS bill is over 25%, the excess comes out of the trust. Any year where the bill is under 25%, after this money goes into the trust. So you can budget 25% of pay, it's going to be 25%. You don't have to worry about up or down. We pick that number, so it gives us 25% until the rates are projected to be below. We pick that number so that if we track the funds, we accumulate funds, we start spending it when rates are high, and we pick the number so we just run out at the end of time. But if you think about this, I've got my money invested in a trust, which I'm assuming earns 5% for like 6 or 7 years, and then I spend it all and it's gone. That's why the savings are less. It's not that inherently there's a lot less savings in a 115 trust. It's just so we set it up to spend all the money right away. Allows you to forecast your costs. The other thing that might happen with a 115 trust is that you forecast your costs for this, but I don't know, it turns out you got a lot more revenue out here than you thought you would. You don't really need to spend that money. You just let the money sit there and accumulate and either have a bigger rainy day fund, pay more of it over to CalPERS, but you just have a lot of options. You can do whatever you want.
Who makes those decisions and when are they made?
That would be up to the city. So hopefully the city council would decide who's going to be in charge of that. And it's actually a really interesting question. I had one city I talked to that was leery of this. A lot of agencies are worried about future councils. What will the future council do? Will they just drain this fund right away and not save it? This city was worried that future councils would not spend it in a time when they needed to spend it. So there's, a little bit of, do we trust the people 10 years down the road to do what we intended when we set this up? If you give the money to CalPERS, that's not a worry.
You're addressing the issue that was in my mind too. It's great to set this up. Who's going to be there to see to it that the plan that's put in place is actually acted on? I have more faith in the randomness of markets than I do of humans.
We want to again say that the money that's going into the trust
It can only be used for pensions. So you can't, we're in the fire station, we can't just take all that money and buy like a fleet of new fire trucks. But we can pay for, however many years, 4, 5, 6 years, we can choose to pay our whole CalPERS bill out of the trust, and then it'll be gone. So it's important if you go this road to have your council think about what they want the purpose of the trust to be, when is money going to come out of the trust, and really set that down, and then monitor the trust.
On this chart, is that green line, I mean, this is what we're
Yes.
projecting, but it's
Yeah.
how variable it is.
So those, let me go back to, I'm sorry, I'm going to way back, everyone's going to get busy. Way back to miscellaneous. Let's see. This chart. So that was the beginning of this green line. I think it didn't go the full 30 years, but you can see up here is your 25th, your poor returns, and down here's your good returns with the kind of floor on it. It can't go below. So there is a lot of variability.
So you have to make decisions sooner or later, depending on
Right, how things are going. The other thing that can happen is if you set aside money in a 115 trust and CalPERS has 5 plus 20% years in a row, so that your plan at CalPERS becomes fully funded, you might not really feel like setting more money aside towards pensions at that point, but you're still required to pay normal cost. You could use what's in the 115 trust already to pay that normal cost. So it wouldn't have to come out of the budget. It seems like a stretch to kind of imagine that CalPERS would get too fully funded on its own, but it's happened before. It could happen.
So I have a question. If you go with the flexible,
Mhm.
with, I mean, with the,
The 115 trust,
with
yeah.
the trust, are there regulations, or would you set up something, or could you set up something that says, this is how it should be used, and these are the regulations for using it or not using it, when to use it, how much to use,
So
based on something that's, I know.
yeah, so there's no government regulations except to say this has to be spent on pensions, on CalPERS pensions. But this is where you would want the city council as part of their resolution or whatever in the process of setting this up to really lay out how we want this used.
Right. Okay, that, and that would be part of what the city council did if they went ahead and did the trust.
But could a
Yes.
future council do a new resolution changing that?
Right.
Is it irrevocable trust?
Yeah.
The trust is irrevocable, so the money can never come directly back to the city. Just
That's the important thing. It's irrevocable trust.
they can't just take it back, but they can spend it down for pensions.
But they can change the rules about how they want to spend it.
How much?
Or how much, yes.
Yeah,
Imagine that when you're drafting, you probably have drafted in a way that complies with IRS regulations, but let's take it, for example, in a state bank trust, you can put a whole bunch of other stuff into the trust itself. Do you have some flexibility about putting those sort of internal guidelines or policies into the actual trust document?
So most of the time, just to save costs, you're going to go with an established trust provider, okay? Either CalPERS or the other companies that do it. And so they have a standard trust document. It's got its IRS qualification letter. So that will govern the trust, but the council can say, we only want to spend the money in these circumstances. The council should also be saying, we want to invest aggressively, we want to invest conservatively, we want to be middle of the road, and kind of give that kind of guidance too. Either that or delegate that decision to somebody else.
Who's these established trust providers? Who's doing the money management? They have their own internal money managers.
I believe they're PFM is a money manager, so I think they run their trust. Keenan, I assume, has it contracted out. I don't know for sure, but they're really a brokerage firm. Cars, I think, uses US Trust, if I remember right. They have a Highmark Capital maybe is actual money manager. CalPERS, I assume, is doing it internally with their own folks.
Any trustee that would be hired, any trust company that would be hired, would be given a mandate in the form of an investment policy statement. And that investment policy statement is something that would be created by the creators of the trust. But once it's put into place, then the trustee is bound by the rules of fiduciary duty to follow the investment policy that they've been presented with. They don't freelance. What's the challenge is, whoever is responsible, the investment committee for the trust that is going to be an arm of the city, they could come back and say, we want to amend the investment policy. I mean, that should be a difficult thing to do. I mean, it should be flexible enough for it to be amended if there is, in fact, a good reason to make that change, but it shouldn't be something that can blow with every wind of headlines or the markets, or the political winds that sometimes blow through councils.
Very true. So I've said that probably you want to go with one of these organizations. The way they work, PARS is far and away the most popular, because I think they have lots and lots of people who are actively selling this. Okay. So they have like 5 trusts from, conservative, moderate, blah, 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 and you pick one. CalPERS often offers 2, both very conservative, you pick one. If you go to an organization like PFM, they're going to say, what do you want to do? Give me your investment policy statement and I will invest as you direct. And then you could always set up your own trust. It's just more costly to do, and then invest as you want.
Question, on your page, when you show the comparisons of comparing the trust returns to CalPERS returns, you're stating that CalPERS will likely have longer or higher long-term interest rates. That's confusing because you're saying the index, the flexible, is able to invest more aggressively or liberally. So should they have greater returns, greater risk and greater returns?
So I always think of ours sort of as my benchmarking fund array. Their most aggressive fund they offer is not as aggressive as CalPERS. CalPERS has a lot of international stuff. Right now, they've got 8% of their funds in private equity. They're talking about borrowing to leverage their fund. It's a really risky fund designed for the long term. And unless you went and did that really on your own, you're not going to get anything as aggressive from the other providers. I know we're probably way over time, but can I shift and talk about OPEB for a few minutes?
Yeah, sure.
Okay. There's less there. So CalPERS were really, we talked a lot about rules. Things are very set in stone. There's a lot of rules to follow. All these cost projections are calculations of how CalPERS's rules are going to play out. OPEB is a lot different. Let's just start with what the benefits are when I say OPEB, because even if you know pensions, you probably aren't less familiar with OPEB plans. The city's retiree healthcare plan, I'm generalizing a lot. People who retired before 2012, the city pays the one-party premium for the retiree health plan. For other people, except for miscellaneous employees hired after 2020, they pay sort of $625 or $715 a month, depending on your category. So a fair amount of the single premium, but not the whole thing. People who were hired after, miscellaneous employees hired after 2020 get only what we call the CalPERS minimum, which is running about $140 a month right now, so a much lower benefit. The health plans are provided through CalPERS, which requires that you pay at least a minimum benefit to your retirees for healthcare. The city doesn't do any other potential benefits. They don't provide retirees with dental or life insurance or vision or fund their Medicare benefits. The city is not pre-funding the obligation at all. There is no requirement that you fund your retiree healthcare liability. The way the accounting rules work is if you're not pre-funding the liability, when I discount those future liabilities, I can't use the 7% that CalPERS uses. I need to use the municipal bond rate, which for last year's reporting was 3.5%, and this year's reporting is going to be 2.2%. So a lower discount rate gives a much larger present value. If you're pre-funding, you can use the expected rate of return on the fund, so things get a lot smaller. Here's the way they looked at our last valuation in 2019, which was for 2020 reporting. There was $16 million using, again, the 3.5% discount rate. So everything's inflating a lot. The liability for future retiree healthcare benefits was $16.8 million. So a very big number. So the question is, why should we pre-fund the liability? There's a financial reason. If you pre-fund the liability, you have assets set aside, they're generating investment earnings, and you can think of it as we're paying some benefits out of investment earnings instead of our budget. There's a concept we call intergenerational equity, which means who should be paying for this? So if a city employee, a firefighter, is providing a service to me right now, they're putting out the fire in my house, I'm paying for their salary. I'm paying for their pension because I'm required to pre-fund their pension. Why should the taxpayers 20 years from now pay for this person's retiree health care? I should be paying for it along with paying for salary and everything else. And then there's just sort of the logical argument that retiree health care really isn't any different than pension. If we think we should fund pensions, we should fund pensions. What happens if we pre-fund? These numbers are rolled forward to June 30th, 2021, so they're a little different than the previous page. At the 3.5% discount rate we just saw, the liability would be about $17.5 million. If I can put it in one of the more aggressive funds, say at PARS, that would earn 6.25%, and the city would commit to a certain amount of funding, that liability would drop right away to about $12 million. Because I'm discounting everything at the higher interest rate, or the other way to think about it is I now am generating investment earnings and I'm going to pay these benefits out of it. So I'm taking credit for that. If you took a much more conservative fund, you might get to sort of $14 million. But any way you do it, the liability that you're reporting for financial statement purposes is going to drop, which also means sort of your future funding obligations have dropped because you're paying costs from investment earnings. We would calculate, if you did these two things, we would calculate a recommended contribution. The city would not have to pay those. This is your plan, your benefits, your funding, whatever you want. But sort of in the 6.25% world, we would calculate that you ought to be putting about 1.2 million into the trust every year. But right now, the city's paying $840,000 cash every year in benefit payments, so it would only be an increase about 400. If the less aggressive, more conservative trust funding, it would come out to about 1.4 million a year. Again, you're paying 840, so about 600,000. There are a lot of rules about what discount rate I get to use for accounting, and a little bit depends on how much you're committed to going forward. You wouldn't necessarily have to make these payments, but just kind of get your head around the kind of numbers we're talking about. So this is a projection of what it might look like going forward. So right now you're on this blue line. You're paying benefits as they come due. They're going up every year. On slide 91, we're almost to the end. Okay. The orange bars at the bottom are the normal costs. That's the cost of benefits being earned every year. And the gray bars are what it takes to pay off the current unfunded liability. So the way we did this sort of sample calculation was, let's pay off the unfunded liability over 20 years. Let's make these payments for 20 years, and then we'll be done, and then we'll only pay these orange payments. Or do we just want to keep on this track of paying the blue line every year, which is going to go up? There's different ways you can structure paying off the unfunded liability. We took this red line where the payments go up a little bit every year. You can also choose flat payments. You can choose shorter periods. You know, we would have discussions about what do you want, how much money do you have, how do you think it would work. It doesn't make tons of differences in the dollars. Either way, you would end up paying off the unfunded liability over sort of probably in a 15 to 20 year time frame, unless, you know, maybe you come into money. That was my last slide. So OPEB is totally in your control. The benefits are very much in your control. There's still bargain. It's hard to change benefits for current employees. And CalPERS does put that floor minimum on that you have for future miscellaneous employees. But whether you fund, if you fund, how you fund, what kind of schedule you want is all up to you. The big bang for the buck you get is sort of financial statement wise. Once you put money in a trust and commit to some sort of funding program going forward, we get to use a higher discount rate, and the liabilities come down. We've asked, I don't know if you issue bonds, probably not very much, but we've asked sort of what bond analysts think about funding OPEB. And the answer we get is kind of outside of California, they don't see a lot of it. So it's really not in their analyses, but you get a gold star. I mean, it's a sign that the city recognizes its obligations and is doing something about them. So it doesn't really go into formulas, but it's a good thing and it's viewed positively. But other than that, it's really all a question of where you think the money could be most used.
Before we open it up to some more questions and discussion, do you have any public comments on this agenda?
Is there anybody joining the meeting? No.
Okay. I'll just throw this out to the commissioners for questions and for discussion.
So I have a question. This is Edwin. I mean, maybe you already covered it, and it's kind of repeating what you said earlier. But you know, one thing that one positive thing I'm taking away from this presentation is that it looks like there's light at the end of the tunnel. In like a matter of 15 to 20 years, it looks like, you know, our contributions as a percentage of pay will normalize to be much lower than what we're paying now. So what are some of the primary drivers behind that kind of, you know, almost sudden change, like in that 15 to 20 year time frame?
So
for example, I'm looking on like page 32 is one example. I think you had a few charts that kind of look like that.
Yeah, actually, I'm just, to avoid scrolling, I'm gonna look at this one, okay?
Okay.
Shows that same downturn.
Yeah.
Right now, you have an unfunded liability, right? Total CalPERS liability of $47 million. It's made up of lots and lots of layers. Each one of those layers is getting paid off over its own time schedule, somewhere between, I don't know, probably 10 years for the shortest one and probably sort of 25 years for the longest one. So think of it as having a whole mess of mortgages with different time periods. And you're making payments on them now. Most of the payments are actually escalating. They're not flat, they're escalating 3% a year. So that's why we get this upward curve. But somewhere in the early 2030s, some of those oldest ones are done. And you stop having to make that payment. And as those payments get paid off and drop out, that's what's happening over this time period.
So this is just purely an artifact of amortizing the unfunded liabilities over the next 15 to 20-ish years.
Right. And the most likely event is that we don't have, I want to be careful. We will always have new pieces of unfunded liability because things never go exactly the way
Right,
we expect. But we're hoping that the pluses and minuses equal out, that we're close and we're doing a better job of guessing where they'll be.
Also, you're taking into account the actuarial tables too, correct?
Yes.
That's a key point on that, because if people are retiring, what people
Right.
are retiring now.
And we've, so this is not when people are, this is actually not when people are retired.
Okay.
So it's
Right.
just that, because I've got all those costs already built in.
Okay,
But it's just, I'm done paying for them.
all right.
And then the amortization schedule of, the 15, 20, 25 years, is that something that's under our control at all or not really?
You can ask, you can do a fresh start and ask them to, ask to be allowed to pay it off faster. If you make that change, your payments go up and they're locked in, but
Right.
you can't stretch them out.
Oh, you can't make it longer. So we can't ask for a 30 or 40 year. Okay.
Nope. You can pay faster, but not slower.
Okay. And is this calculation continuously recalculated? So like 5 years from now, our unfunded liability is going to be very different from what it is today. How would that affect the projections at that point?
So it's recalculated every year. And most of the time, it doesn't make a ton of difference. I don't have my, oh, I do. I didn't think I had the fast scroller, but. If we had looked at, we're on safety now, slide 50. If I'd come here a year ago, this line would have been going up and up and up and up and up. And then kind of, I don't know, might have hit 70 and then it would be coming down. The positive 20% return had a huge impact.
Mm-hmm.
Most years, it doesn't really matter that much. I mean, you can see it if you really look at the numbers, but this changed the whole shape of the curve. So we know there will always be unfunded liability in the future. CalPERS has just spent so much time really trying to do a better job of guessing. We're hopeful it really will all go away down here. I think I'm not sure I answered the question.
These charts that assume that you're going to have the revenue from the contributions.
Yes.
And so, but in the short term, it's 5 years or so, we're going to be paying more into CalPERS. That's going to be cutting into our budget, which in a really tight, balanced budget, but not a lot of wiggle room here.
And-
So while I'm seeing a light at the end of the tunnel, I'm also seeing if we don't do something, we're going to be having to make hard questions about cutting expenses or doing the services and meet our own obligations to CalPERS. So that seems to be kind of a scary prospect if we don't do something.
Again, it's much better than it was. You guys are much better off because you don't have the enhanced formulas, but I mean, there is just a ton of variability in these costs and it comes up pretty quickly.
So we're talking about $4 million reserve fund. And some of the charts were, let's take the direct payment to CalPERS. Is there a decision on when to make that? Or are we just constantly doing that something in the very near future? Or would there be some kind of strategy at that time?
So we did our numbers assuming it was June 30th, 22. It's really up to you. I can't predict the market. So if you could, you would know when the right time was. But you're paying interest all the time on this liability. So if you weren't worried about what the market was doing, you're probably not getting 7% from Lake. So that would say do it sooner.
Yeah.
But you know, there's a lot of other things to think about.
This is what I'm wondering is, what's the worst case scenario? Give a bunch of money to CalPERS, and then a year later we come back and go, that was a bad idea.
Yep.
Why do we do that? So I guess I'm trying to give you a better sense of like what the risk is of doing that, and how that could backfire.
Okay, so I will tell you about County of Riverside issued a pension obligation bond in 2005. And if you think about your investment history, remember that 2008 was very shortly after 2005. So they took out a loan for a lot of money. They owe the payments on the loan. They gave the money to CalPERS. CalPERS had a 30% asset loss. They were probably feeling very unlucky for the first several years because now they have to essentially repay that money to CalPERS, and they're still paying on the bond. We've been tracking the performance of that money since 2005. And at this point, they're actually ahead of the game on that money. So even though it seemed pretty disastrous right away, it really is a long-term investment. And in the long run, it was okay. But you need to make sure, I mean, $4 million isn't, it's a lot of money, but it's not a really lot of money. What, if they just lost that money, would you be okay with it? I mean, you're not okay with it. Could you afford it? I guess it's a question. You're not counting on it reducing your CalPERS contributions. In the long run, probably it will be a good decision.
If they were to do losses, we would cut into our base anyways. If we give the 4 million to them, and then there's losses, it's going to cut our original base down anyways. So
It's going to cut your original base down. Your required contributions are going to go up. You don't have the $4 million sitting in the city treasury to spend on it, and you're not happy. But is it the end of the world? Probably not.
From that perspective, though, the trust would be safer.
The trust can also lose money.
Yeah, so how it's good for that.
So if you're really thinking about it for budget stabilization, or like I need to have this money handy in case CalPERS does do something really bad, you would probably want to put it in a very conservative trust. Have the
40-60 or something.
like CalPERS strategy too, 78% bonds. They were thinking that was going to earn 4%. I'm not sure it'll earn 4% these days, but will sort of outperform rate, not a lot more than that, a little bit. You would put your money there so it can't lose. I don't know how popular that is.
I just get back to what we're talking about. South Pasadena is going to be good for. That's a big county. We think long term thinking about it. And we put $4 million in CalPERS. We get a return every year of 7%. Always keep that in mind. Well, markets go up and down, but we're saving 7%.
You're saving the 7% they're charging you. They're charging you 7% on the unfunded liability.
There's a stat you had here that probably didn't jump out to everybody, where you state the average, like for example, the average CalPERS safety plan is 68% funded, and we South Pier 69% funded. And along the same lines, the average miscellaneous plan is 72% funded, and we're 71% funded, which tells us we're like right in the middle. Which to me would mean that if we would want our portfolio to be somewhat conservative, we don't need to set the world on fire with our portfolio. We just need solid gains because we're already in the middle,
Yes.
middle to the head of the class.
Yes.
So that would be an investment policy like a treasurer was talking about.
Right. So, and you can do that if you have a supplemental trust. If you give the money to CalPERS, it's going with where they're going. It's a hard decision.
It's
The
a hard
the numbers can't answer it for you.
What does Ellen and Zen think?
I don't know. If we, I'm kind of stuck here now with the 4 million that we have now. Let me just break this up into a couple of things. The 4 million that we have now, if we put that in, which slide is showing us that if we put that into CalPERS now, we're saving money by not paying interest on that. But which slide was that?
It's 71.
And okay. 71.
So again, depending on what the deal is you make with CalPERS when you give them the money, how you want them to apply it, you can save more or less. And then how much work the city wants to do, whether you accept the lower contributions or try to keep paying more will affect your savings. But there's a fair amount of savings there no matter what you do.
But if we put it in, is that doesn't set off doing one of the oh crap. Damn. Wait a minute. I'm trying to look at my slides.
There are too many pages of too many numbers.
There are the options that we have with them, like if we pay them off, if we change our amount that we're paying them, right?
Yeah, so if you fresh start it, you're thinking of that
If
one.
you fresh, right, thank you. If you fresh start it, you could do the 4 million separately and it wouldn't be a fresh start. That would just be you pay in more than you have, than you actually owe at the moment.
Right.
Right. So, and if you had the trust, you could do that anytime you kind of wanted to. When it worked for given your current situation financially of the city.
Yeah. So you could put the money in the trust and you could say, our intent is that when the contribution rates get really high, we're going to pay them out of the trust. But you could also say, we're going to see, maybe we'll have found a lot of revenue by then and we don't need it. Or maybe something will go wrong sooner and we need it sooner. But you can, as you say, see what the situation is.
What's the really biggest downside of the trust?
The biggest downside of the trust is that, we've had a down market as much as 43%, and we've had innumerable financial crises, always followed by a recovery. The biggest risk is, again, is not the markets or the investments. The biggest risk is the human risk that we lose our conviction, we lose our courage, and we make a dumb decision with the money.
Okay. Yeah, I worry about that, actually.
There is always going to be another financial crisis and another recovery. And every crisis has a different cause, so it feels like it's different every time, but the market always has delivered a positive return once things have settled down. And
Okay, so
by definition, crises are not predictable.
right. And I think my biggest fear of the trust is we're really relying on people who we don't know yet are going to be making the decisions. And so, you know, if I decide that I think our board right now is really good and will make the right decisions because they're stable and sound, I don't know what's going to happen 5 years from now. And that concerns me.
I don't know what's going to happen tomorrow morning.
Yeah, I understand, but I mean,
Yeah, I kind of share those thoughts too. I think that we can, all of us in here and everyone on the council can all be in agreement about how we want this to play out and what type of decision we will want people in the future to make depending on, you know, what happens, but we ultimately don't have control over
okay.
that.
I'm sorry, I couldn't hear that.
Yeah, I was just saying we can all agree now, here now in 2021 about what we want to happen and what kind of decisions we want to be made in the future. But ultimately, that's out of our control. It's going to be a new.
Yeah,
and
that's difficult too. I agree.
But it seems to me that with this 4 million, it would make sense to deploy one of these strategies. You know, I just don't have a strong feeling about one or the other, and I can see the clear benefits and also drawbacks for each of them. So I don't have a strong opinion at the moment. I'm not sure how the other commissioners are feeling, but you know, it seems like there's trade-offs.
Yeah, I think, you know, this is Edwin. You know, based on the two kind of very high level decisions of setting up, doing a trust or just giving the money to CalPERS directly. You know, my personal preference is just to simplify the operational responsibilities of running our government by just giving it to CalPERS like when we're ready.
Yeah.
And that way we don't have to think about who we're going to pick as our trust provider. We don't have to think about what investment policy are we going to deploy? When are we going to use the money? How are we going to use the money? And then fully knowing that whatever we decide today may be changed down the line. Of course, there's costs associated with hiring those people to run the trust. There's just a lot of variables, which obviously if we manage it well, then I think we would benefit over, you know, just doing the CalPERS option. But I think for the sake of just simplifying, you know, the operational burdens of our city council, and just kind of, you know, knowing that, you know, this is how the money is going to be used. You know, I think there's a huge benefit of just, you know, taking that responsibility off of our hands.
I think I agree with Edwin.
Okay, I'm just gonna chime in. Can you hear me?
Yes, Zen, we can hear you.
Yeah, I'm gonna agree that we don't really necessarily have the expertise for this trust, and say that if we're gonna do something, then, well, we should do something, and CalPERS is probably the best solution.
I can chime in my experience with the trust. Over at San Gabriel, we had a trust, and San Gabriel for a couple of years didn't have the cash flow to actually make any deposits with the trust. But I will say, like you guys are saying, that it was a little burdensome because the rep's always calling you. You got to do disclosure. It's a lot of Yeah, it's a lot of extra work for staff. Those are my 2 cents.
I think that's important information.
And I think someone mentioned that CalPERS, I mean, if you're gonna go the way of the trust, then maybe do the CalPERS trust that has more, kind of more long dated, higher return risk profile. It just kind of match your liabilities a little more. But I feel like you might as well just give it to CalPERS directly.
And
That seems like the most straightforward solution. The second part is, do we try to commit to making the same original payments?
right, make those payments with what they would have been without the extra money into CalPERS. And I would just recommend too, remember, you can do, send money to CalPERS, but still set up a fund for OPEB. You can split your decision. I can tell you, I have experience.
Rescue ambulance.
Hold on.
Response, shortness of breath, ALS.
1081 RE, the Redwood 219 via Delray, off the Monterey Road in La Portada, Redwood.
As I was saying, you can split and send the payment to PERS, but still set up a trust for the OPED. It's been my experience, Sierra Madre had a trust for OPED, and it was not, and maybe because the dollar amounts are less, there's more flexibility, but it wasn't as difficult to administer as a PERS trust, which is why the city just went with the OPED. They're smaller dollar amounts. And I can tell you, 20 years later, the city isn't spending any money. All of the money can come from the trust fund now to pay for OPED. You get to that point because you're dealing with smaller numbers. Just an idea to throw out there.
So, that idea, something like a 50-50.
Well, I don't think you need 2 million into OPED. What was the recommendation here? I think
We use
they use like
600,000, just trying to sort
Right.
of do it proportional.
it doesn't need to be a lot of money. 600,000.
Oh, then, yeah. Okay.
And that was just to be proportional with the pension.
That's a good idea.
Just an
I
idea.
like that. Yes.
Are we looking to support kind of real general recommendation?
Yes, I'm pretty sure the council would like, I know it's difficult, but I'm sure they would like to have a general recommendation from the commission. Again, emphasizes this is background information that's all going to go forward to the council as part of the strategic planning process to figure out what to do with the money. So it's hard for a council to make a decision on, yes, let's put this 4 million towards pensions without having information on what the cost savings are, the different alternatives, and what the commission recommends.
I'm hearing, it sounds like a consensus that you would recommend for the CalPERS part of it to make a direct payment. These things. Difference to
Yes.
someone wants to make an initial on those lines, if I prove that correctly.
Can I attempt to make a motion? Are we talking about 4 million or 4.4 million?
Actually, the commission can decide. I rounded it to 4, but the total amount is 4.3.
I'd like to make a motion that we, of that 4.4 million, that we put $3.4 million direct payment to the CalPERS. Unfunded liability.
Fred, I'm sorry, I'm having a hard time hearing
Okay,
you.
sorry. I move that we, out of the $4.4 million, that we put $3.4 million, make that a payment to the unfunded liability in PERS. remaining $600,000, we'll set up a fund for the OPED funding.
So that would be, are we doing 3.8?
No, 600,000.
600,000
3.4, 600,000.
for total.
Yeah.
So it's not quite all the money.
Did I get coming to the
If we're gonna like 3.6 out the reserve.
If you want to do, let me get the exact amount. It's,
I think we can see 600 for OPEB and then.
The rest.
Okay, let's do it that way.
Okay.
All right, let me do it that way. Okay. All right, let me redo the motion. I apologize. We have a motion to set up the trust. 115 pension trust for $600,000 to the OPED funding. The balance used for payment of the unfunded liability toward the unfunded liability in FERS.
Do I have a second on that motion?
Second?
All right, let's take a vote. All in favor, say aye.
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 All opposed?
I,
Sorry, so how much does it cost to set up this trust?
we'll return with information. This isn't set, is it set? Council still needs to take action. By the time we're ready to take it to council, we'll have additional information on that. On what the costs are.
Okay, and is this the full amount that we're pondering? Like, I saw that there was also some other one-off payments that we got from the basically federal aid. Is that something that can be applied to this or no?
There's an additional 6 million in the federal COVID relief money, also known as ARPA. The commission is welcome to, if there's additional money from that ARPA money. I can tell you the ARPA money is going to be, there's going to be a lot of requests for use of that money. But nothing would prohibit the commission from saying the council should consider using some of that money towards pension liability also. Ultimately, it's the city council's decision, but I know that ARPA money is going to be, there's going to be a lot of interest in how to spend it, put it nicely.
What are some of the things being considered for that money?
That is all going to be considered as part of the strategic planning process, which has already begun. There was a link to it in the staff report. There's surveys being done. There's going to be public meetings done. So I would recommend, the commissioners participate in those surveys, in those meetings. Part of when the strategic plan is developed, the new program things, the funding source could be the ARPA money. So it's too early to tell, but it's all going to be decided through a strategic planning process.
Didn't we had a discussion at a previous meeting on ARPA? Wasn't there 5 different categories or am I thinking?
Yes, no, you're right. There was a previous discussion. There's like 5 different categories. Water infrastructure, social service type programs. I don't remember them offhand. I'd have to pull the report, but it has like five or 6 potential uses.
I think the ARPA also has some restrictions, and unfunded liability might be.
I think I do recall, now that it's coming back to me, I do recall specifically it says it can't be used for pensions. I believe Albert's correct.
So that's off the table then.
Yeah, I believe that.
Yes, that's all set.
I know Lucy, if she's still listening, she's our expert on ARPA. I don't know if Lucy's still listening. But you're right. I think it is a strict prohibition.
Yeah. So we are getting a little more than we.
Originally it was 4 million and the final estimate's coming in at 6.
Okay, good.
Mhm.
All right.
Okay.
Well, thank you so much, Mary. That was
Yeah.
really
Yes,
great.
thank you.
Overview and you really fleshed out the slides and have a much better picture of what's happening, what the options were. So thank you so much for making that really, really understandable for us.
Well, thank you so much, and thank you for listening for 2 whole hours.
We warned them ahead of time. It was going to be a very meaty meeting, very meaty, very beefy.
Thank you.
Thank you, and you're welcome to go home if you'd like, or sit for the rest of the meeting.
It's okay with you.
That's okay with us.
I'm gonna leave you guys to running the city. I'm gonna go home.
Thank you so much.
Thank you.
Okay,
All right, moving on to item 2 on the agenda.
if
This
you
is-
can, yeah, Stephanie will pull this down so we can see people here in a moment and they can see us.
Yes, okay.
There we go. Now everyone can see us again.
Oh, much better.
Much better. Are you ready for the next item?
I think so, yeah, this is item number 2, the finance department policies and procedures updates.
I'm going to scoot over a little bit to get closer to the speaker and be able to speak without my mask. So I'm gonna move 6 feet away from everyone. In a chair that's too tall for me. Okay. As the commission is aware, it has been a finding on our audit, at least for the past 2 years, that the city does not have comprehensive, complete, up-to-date policy and procedure manual for the important functions that the finance department handles for the city. The ad hoc committee reviewed this matter. If the commission recall, we briefly brought it to the commission. Staff was in total agreement with the idea of perhaps the best thing to do was to bring in a consultant to prepare these, working with staff, but at least driving the project, getting it done quickly, given all the other projects and things that the finance department is currently handling. So the city manager authorized Ken and I to reach out to potential consultants, and we would recommend that management partners be the consultant selected to prepare this manual. They will ensure that our policies and procedures will meet the GAP guidelines, the Federal Single Audit Act 1984 regulations. There's a lot of acronyms, the GOA auditing standards, there's Yellow Book, Green Book, but basically make sure in the end we end up with a policies and procedure manual that will not only be abide by municipal requirements, but also federal requirements, because as we were just talking about previously, there's going to be some federal funds. The city has already received, I believe, half of the funds already. ARPA funds that are federal funds, and we'll need to make sure that we're abiding by federal guidelines as we expend those dollars. So attached to the staff report is a proposal from management partners along with a scope of work. The staff recommended that the initial areas to include in the policy, capital improvements, fixed assets. Again, these are looking at we're trying to link it to correct our audit findings and the minimum that we need in order to be able to check the box when we start wanting to expend the federal funds. Capital improvements, fixed assets, purchasing, accounts payable. Number 3, utility billing. Number 4, general ledger maintenance, which is our year-end, month-end close, bank rec. Our accounts receivable, cash receipts, our treasury and cash management functions, and payroll. There is a footnote on payroll. The city council, not sure if the commission's aware, but the city council in August decided to end the city's relationship with ADP for payroll preparation, and we will be bringing payroll preparation back in-house. So we're in the process now of that project of bringing payroll back in-house. That section of the manual will need to be done at the tail end of the project, because we don't want to do it based upon our current procedures. We want to do that manual based upon when we're doing it in-house. That's a footnote on payroll. The total cost that is proposed is $42,900. The funding for this project will be spread out between the general fund, water fund, and sewer fund reserves. to pay for it. The actual amount will be determined when this report goes to the city council. In the meantime, staff is bringing this to the commission for your review and to obtain your recommendation to the city council regarding awarding this contract and proceeding with this project. I'd be glad to answer any questions.
I have a question.
Mhm.
What kind of process will they be using to create the policy and procedures? Will they be looking at our staff and seeing how they're doing what they're doing now?
Exactly. The phase 2 of the project involves, I believe it's 2 hours each staff member interviews to document the processes that staff is currently using.
And I would assume that if we're doing anything that is not okay under all of those guidelines, these people will be able to say, no, you can't do that.
Correct.
Okay.
Correct. I should also mention as we go through this process, as soon as we did include in the scope of work, these policies and procedures, the manual to come back to the commission for your review before it goes to the city council. Our intent, what tends to happen when cities do this is you don't want to create a document that gets created, it sits on the shelf, it's never updated, it's not really used. It needs to be a living document. So our proposal is that the initial manual is going to be reviewed by the commission, forwarded to the council will approve it. There's additional policies that we should have that are recommended, but they're not really required, but I mentioned a few of them in the staff report. Any policy that isn't in violation of the municipal code in any way, doesn't affect the municipal code in any way, we would have an administrative process where the city manager can approve those additions to the policy. I give an example in the staff report. Let's say 3 years from now, we change the process of doing accounts payable, how we issue, we process invoices. As long as staff isn't changing dollar limits or, what the city manager is authorized to approve, we can update this policy, get the city manager's approval, and have a new updated policy. But if the staff wanted to revise the policy, so for example, increase the city manager's account authority, that could not be done administratively. That would require a city council municipal code amendment in order to increase limits. So anything that doesn't require a municipal code amendment would be updated going forward based on the city manager's approval. So there's a safeguard there that the policies won't ever exceed or authorize anything that staff isn't explicitly authorized to do in the municipal code.
Thank you.
And it looks like the project schedule, they're shooting for a target of that February this year.
It was about 5 months from when they get started.
And one question I had was there was going to be staff interviews. I was wondering whether you were going to participate in those.
Unfortunately, I won't be here by the time they start this project, but your staff has all been here for at least 2-3 years. And Ken is an experienced finance director, so I don't think there being any issues or problems with proceeding without me. Yeah, there's not a problem proceeding.
And it looks like we're committed to 2 public meetings. And assuming that one of those be presenting the draft to the commission and then the next.
Correct.
And am I correct that they're going to primarily focus on those 7 priority areas? But there's going to be some filling in of other policies internally by staff. Is that
correct? That's correct.
Just to comment on Elaine's talking about the ability to make changes later on. The majority of that is that technology is moving so fast. We don't want our policies to come outdated 6 months after we implement them. So that's why we're asking for the ability to make changes later on.
And there's also going to be procedures on updating, and who's going to be responsible for identifying what needs. Any other questions from the commissioners? I think just from my perspective, it's, I'm for this. I think it's, I like the plan. It's hitting all the target areas that we've been discussing here in this commission and also in the ad hoc finance committee. And we need to do it. Functional manual that's tailored to how our city operates. So I think it's any other discussion on this agenda item? Right, so let me see what motion would be to recommend that the city council approve the contract with management partners to prepare policy manual from the to the scope of work that they proposed.
Okay,
That's correct.
Okay. Second.
All right. To the vote on that, all in favor say aye.
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 Did you?
Did we lose Zen?
Did you vote?
Her microphone.
Yes, did you hear me?
Okay, great. Now we can hear you.
Sorry.
Okay. All right, so it's passes unanimously, 5-0. Thank you. Item number 3 is sales tax update.
Chairman and members of the commission, this is always a fun item. I'm going to give Stephanie a few seconds to pull the newsletter up on the screen so everyone can see it. This is your quarterly update. This is an item on your work plan that staff is to bring the quarterly sales tax update, property tax update. We haven't received that one yet to the commission shortly after we receive them. This quarterly update is for the first quarter of 2021, which covers the months of January 2021 to March 2021. And yes, there is a good 6-month lag in this report because the businesses have 3 months to submit the information and the payments, and then the consultant takes 3 months in order to put all the data together. So it ends up being about a 6-month lag, normal processing. According to the current sales tax update, I'll start with the bar chart at the top. Probably the two most significant things I'd like to point out is that restaurants, revenues from, it says restaurants and hotels is the category, but you know, we're just restaurants in South Pasadena. The category of restaurants and the sales tax receipts from restaurants has resumed its first place ranking in South Pasadena. Prior to COVID, revenues from restaurants was always our #1 sales tax. COVID hit and it flipped between restaurants and the county and state pools. You might recall the last 2 updates, the county and state pools were in #1 place and restaurants really dropped. We are seeing a gradual return to normal. We're not quite there yet. As you can see, the gray bars are last Q1 of 2020 and the green bars are Q1 of 2021. So you can see by looking across the bars that things are still pretty much lagging from last year. With the exception, our county and state pools are still performing like gangbusters, better than last year.
Yeah.
One of the things to note that's different in this reporting is, and we were expecting this, our sales tax total receipts from county and state pools has actually dropped if you look at prior reports, and that's because of a change in law. You might be familiar with a lot of cities, especially in the Inland Empire, building these huge Amazon warehouses. State law has changed where Now that if there's a facility like that located in that city, they get to keep the sales tax revenue. It's no longer required for all of it to be distributed based on where it's actually being delivered. So we were anticipating that, I should say, wait, our consultants, HDL, were anticipating that change. So it's reflected in our numbers for the fiscal year when we did our estimate for the current fiscal year total sales tax. So we did see a drop in that, but it's still performing it's still a very healthy sales tax source for the city of South Pasadena. Fuel and service stations, I'm telling you, driving on the freeway, you would have thought they had rebounded already, but it hasn't. We're still lagging in that area from a year ago. Overall, it looks like on the report that our March sales, the first quarter, we were up total by about 27%. Unfortunately, that's deceiving because of the governor's order last year when COVID hit to allow businesses to defer submitting their sales tax receipts. So it was artificially deflated. So now those receipts have come in, which has artificially inflated the city's number. So when those deferred payments are factored out of our numbers, our actual sales activity for the first quarter decreased by 7.7%. If you go down to the top 25 producers, I always like to show those top 25. They're in alphabetical order. They're not in order of sales tax receipts. As the list is very, you could tell, weighted towards our restaurants. Ace Hardware continues to do very well. Our grocery stores continue to do well. Our fast casual restaurants actually really brought in significantly more revenue than they did. Those are doing really well. It's our, what do you want to call them, our fancier restaurants that are still haven't quite recovered, but our fast casual are just doing gangbusters. Habit Burger Grill, I think this might be the first time they popped up on this list. It's their first time on the list. They're doing gangbusters. So these coming online, it was just perfect timing, and we like our hamburgers. The next page, if you go to the chart, the pie chart, what this chart does is it just shows the revenue, the total sales tax revenues for the first quarter. And this chart shows that, again, restaurants are 24% of the receipts for this first quarter, followed by the pool, the county pool at 18%. And food and drug is actually a little bit more at 20%. So it's restaurants 24, food and drug 20, pools 18, and everything else, all the other sources making up the rest of the receipts this year. The summary of all of this is that we're still on trend, according to the first quarter report, of hitting the estimate that is in our proposed budget document. We were anticipating that change in how the county pool funds are distributed to cities. That was anticipated in advance. So at this point in time, I'm pleased to say our numbers are still right on. We're not recommending any revision. Unfortunately, not an increase, but also not a decrease in our sales tax revenues from the first quarter. So we're still doing well. I'd be glad to answer any questions.
Just out of curiosity, do you know what led to the change in the rule of the house?
It was, however, the sausage that is the state legislator and however laws come about, probably a lot of lobbying by the cities that have those facilities in them or about to go online in them, and getting enough legislators to agree to vote for that change.
There is one little positive caveat that most people don't know. Yes, as they said, there's new law and this new point of sale is indeed what the warehouses are. However, when South P put in the recent transaction tax, that's technically a transaction tax. Let's say you live in South P, yours on Amazon, someone's delivered to your door. South P still gets that transaction tax. It's not lost in the point of sale that's going after the big warehouse cities. South P still generates those dollars directly.
For the Measure A funding.
For the Measure A portion.
Yeah. We have two types of sales taxes now.
Yes. We have the main, what's called Bradley Burns, that's the main sales tax. And then we have that additional photo food, recent photo food. That little additional, if someone ordered from Amazon, will stay in the city because the delivery is in the city. It's a transaction in the city.
Right.
So we still retain those dollars.
So I guess that.
Another plus to Measure A. Mhm.
That's good.
Thank you for that. And this is just to receive and file.
For the motion to receive and file the sales tax report. Second. Second for one of that line. I'll do the second. All right, let's vote on that. All in favor, say aye.
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 Also unanimous. Thank you, Corinne. And we're moving on to item number 4. This is our just to refresh everyone's memory, 3 meetings back. To have a second to put in just a brief oral status of the for meeting agenda. So this is just going to be a brief oral overview of the
Thank you, commissioners. This is going to be a standing item on every agenda. We won't put it on your next October 7th agenda though, because that's a little soon. There won't be, but in December, you'll have another update in December. Staff is very close to being able to completely close out fiscal year 2021. We hope to be able by January to actually schedule the auditors to come in and start their audit work. Again, we'll have better information for you in December on whether or not we'll hit the January target. But we're much further ahead, obviously, than where we were last, what month are we in now? Last August. We're much further ahead than we were last August. A lot of progress made, or last September. We're no longer 18 months. Yeah, we're no longer 18 months behind in doing bank recs. Things are in a much better shape, much better. We do have month-end closing procedures. We have a year-end closing procedure that staff is busy working on right now, making sure we complete everything to get it ready for the auditors. And again, we're aiming for January. It'll probably take them 2 to 3 weeks to do 2 months, 3 months to get their work done. So we're hoping we won't quite be done by, ideally, I would like I think Ken would do a January, February completion date. We're probably going to do March, which isn't too bad, completion date of getting the audit to the commission and to the council.
in the auditing schedule is pretty clear for us. Thank you very much for that report. The last, I don't think we need to do a formal.
No, that's just an update. Yeah.
Okay, great. Last item is approval of the minutes from the May and the, I believe there were 2 July meetings, is that right? That's right. And I'm wondering if we control the July, the May 27th. 2 in May and 1 in July. Okay, May 27th meeting. This is the one where we need a recommendation of on the 2021 or 2022. I think these minutes need to be fleshed out a little bit more. Under section 3(1)(I), it refers to a motion to approve the minutes, but there wasn't language in there about moving to recommend that the council approve the budget. So I think that part of it needs to be fleshed out just a little bit more. And also, I was wondering whether we want to put in a little bit more detail about. We had some discussion in May. I think we had also had a motion about a recommendation to the council to put the cell tower revenue is really a separate reserve fund. I think that's important to add in there. And one other change that I recommend is we did get some significant public comment from. I think it might be worth just mentioning that we did receive input from them and discuss and consider now. But as it is right now, this one just a little bit incomplete because it doesn't include the actual vote from the budget. So
We'll revise this one and put it on yours, okay, for your October.
We can have that ready by October.
okay, cool. And I believe that it's a Commissioner Wood abstaining and not present at the meeting. I think she was. I looked at
The wrong section was included in this
Okay, all right.
version of, I apologize for that. We'll make sure we get that to you corrected by October 7th.
Okay, great. Thank you very much. Does any commissioners have any other comments on that, the minutes for that meeting or for the May 20th or July 14th meetings? Would someone like to make a motion to approve the minutes for the May 27th? I'm sorry.
Pull that one.
Yeah.
Pull that one. 5/14 regular meeting and July 14th special meeting.
Right, it's May 20 and July 14.
Okay.
Second.
Let's take a vote on that. All in favor, say aye.
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 Okay.
Your next meeting is October 7th. It will be a special meeting. It will be entirely virtual, that meeting, because it's a special meeting. We don't have access to the council chambers. So the next meeting will be entirely virtual. The reason for the early meeting, just for somebody watches this tape after the fact, we do want to have the commission review the updated investment policy. We're working with the city treasurer to update that. We also will have a presentation from our investment advisor at that meeting. And our goal is to have the updated policy with the commission's recommendation for the second meeting in October for the city council's approval. So in order to make that second meeting in October, staff, we had to move this meeting up earlier in the month.
Sounds good.
Okay, so the next meeting after that is your just regular December meeting. I think it's December 16th.
That's right.
Right.
All right, before we close, City Treasurer Pia, first, I want to thank you, your input on the pension item was really helpful. And anyway, thank you for that. And also wanted to see if you had any comments for us tonight. Jerry, are you there?
I'm sorry, did you?
I was wondering if Gary wanted to make a treasurer's report or comment today. I don't know if he's at his computer right now. So let's see if our council liaison, Jackie, wants to make any comment.
We got to put a very busy meeting. Tremendous knowledge.
Tremendous amount of benefit.
I agree.
Yeah.
All right. Well, give Gary one last chance. Gary, you're out. All right. The motion to adjourn the meeting.
No move.
Second that. All in favor, say aye.
Aye.
Aye. Thank you so much, everyone. It's midnight here. I'm going to bed.
Thank you.
Bye.
Good night, everyone.
Bye.
Thank you so much. Bye-bye.
Here, it's connected here.
Okay, so that's Thursday.
It's October